learning objective. At the end of the lecture, you should be able to explain the role of pricing, explain the key pricing objectives, explain the key factors which influence price setting, describe the pricing strategies and how they are applied. Lecture outline. The role of price component in the marketing mix. First, why pricing is important. Second, pricing objectives. Third, types of pricing for financial. Part 2, pricing policy. 1. The influencing factors and major pricing policies. First, we look at the role of pricing in the marketing mix. First, we look at under the first group, we will look at why is it important, followed by objective and the type of pricing. Why pricing is important? Reasons. Pricing is the only revenue generating component of the marketing mix. Just look at the 4 P's. Only one P that generate revenue. That is pricing. The key factors in achieving this is by volume objectives. That means you try to generate as much sales volume as possible so as to generate revenue, and profit objective. So another thing is that as an organization, they always try to make as much profit as possible. These are the 4 P's of the marketing mix. Look at these 4 P's: product, price, place, and promotion. Price is the only one that generates revenues. It is the competitive tool to differentiate a service and a bank. So for high class service, the banks tend to the price will be higher compared to a normal service with a normal pricing. So it contributes to the overall image created for the service. Just imagine private banking. The overall service is atas. Okay, so which also have this impression, okay, this image of high class service, exclusiveness. Okay, and this will of course carry a higher pricing. A price component must support and blend with the other components. So the price will support other P's, the 3 other P's: the promotion, the product, and the place. Price must be consistent with overall service offer. So if it's a high class service, definitely the price will be higher. Compare it against a normal service, the pricing, or normal standard service offer, the pricing will be normal. So high quality service will be consistent with high pricing. So high pricing is an indicator for high quality service, service quality. For example, UOB Visa Infinite Card. This is a UOB Visa Infinite Card. Why pricing is important? Reasons: is able to respond quickly to the market condition, simply rising or lowering the price. One example, the movement of interest rates on housing loan. Price objectives. There are three areas we're looking at. First one is maximizing profits, followed by increased market share and product quality leadership. Maximize profit. Objective is get as much profit as possible. It does not always lead to higher price. Sometimes lower price may increase the market size and result in greater sales and profits. It may apply to a group of related services or a particular customer relationship that involve several services. So basically look at the whole, look at sometimes one customer may have many products and services. So it may reduce the price of one so as to increase the income from other products and services. Banks may maximize long-term profits, not current profits. Some services are provided free or at low cost so that other products or services can be priced high enough to offset the low profit line of that one product or services. Example, DBS SO Premium Platinum Credit Card promotion. Increase market share. Objective, attract as many customers as possible. A large market share basically has a better economical of scales than its competitors. So for each banks, they always try to reach out, try to win as much market share as possible. And banks with longer run view will always aim for larger market shares. So as a result, lower pricing will help to maximize market share in the early stages of service life cycle. Achieve product quality leadership. This you use price to achieve product quality leadership. So to build a image of high product quality, you price it that most of the time at a high price. Okay, one good example is Apple phone, iPhone. People always associate iPhone with premium product and with high price. And you differentiate from other competitive products. One example is OCBC Titanium card. These are the areas of benefits they focus on: travel, entertainment, fashion, and golf. Types of pricing for financial service. The pricing for financial service are in the form of interest rates for credit facilities, fee or commissions for credit cards and fund transfer services, premium for insurance services, and generally, higher pricings will lead to more revenue for the bank, to the bank. Pricing policies, influencing factors. We are looking at the internal factors. Influencing factors. We are looking at the internal factors here, such as pricing objectives, other markets mix variables, the other three P's, the costs and risk. Internal factors, pricing objectives. It has to be consistent with the organization objectives. Example, a bank aims to be the largest provider of housing loans, so it will set a low price to achieve the volume growth and to undercut competitors' prices. Problems faced by the banks in identifying costs. Often it is very difficult for a bank to distinguish between a fixed cost and a variable cost. For example, labor time typically is a variable cost, but it could be considered a fixed cost for permanent branch staff. Cross subsidization. Pricing in banking has varying degrees of cross subsidization. It occurs between consumers of the same product. Low cost customer cross subsidize the high cost one. Between the sectors, the high profit personal sector tends to cross subsidize the corporate sector. A bank can lose out to its competitors who can cost and price effectively. This is important. You may have very good marketing uh, campaign, but if you fail to cost and price more effectively, you still will lose out. So a better information system can allocate costs to individual service better. So banks do invest a lot in the IT structure, okay, to allocate cost to individual service better. Pricing policies. We're looking at the influencing factors. Under influencing factors, we look at the external factors. The influencing factors for pricing. What are the external factors are? They are shareholders, customer demands, competitors, industry practices, regulation, and intermediaries. These are some examples of external factors. Of course, there are much more than this. External factors. Organization has little or no control over the external factors, but they have to monitor it closely because they have to be careful of the impact it can have on its pricing policy. So look at the graph here. Okay, the graph shows an inverse relationship between the price and demand. It's curving downward. So basically, high price, as the price goes up, the level of demand will drop. The demand or quantity will drop. Let's look at this diagram. This line shows a very elastic demand. It basically means the customer is very sensitive towards price changes. So when the price move from P1 to P2, the price drop from P1 to P2, you can see the Q1 to Q2, there's a very big change. So basically, when price drop by a bit, there's a great demand generated for this quantity. Okay, rather there's a great demand for it. So basically, as a result, you increase your total revenue. So it makes sense for the bank to drop the price, okay, to increase the demand that leads to total increase, the increase in total revenue. So from here, the demand is inelastic. You see the line is very different from the previous one. The previous one is quite flat. This one is quite steep. So when price move from uh, basically the price, okay, what you do is that you increase the price, okay. Since the demand doesn't change much, you see the demand that you increase the price from P1 to P2, but the Q1 drop to Q2 wasn't a lot. So in this case, the bank can increase the total revenue for it, since the demand will not change much with the higher price. Okay, this is a situation where, like for example, Microsoft, for Microsoft Windows, there isn't much competition here. So basically, Microsoft can effectively set the higher price, and generally people will still buy Microsoft product, okay, because there's not much, or rather there's no alternative, okay, product for Microsoft. All right, Microsoft Office. Market elasticity versus bank elasticity. So market elasticity, take note the word is market, okay, is basically see how the total market demand responds to the price changes. If it's elastic, okay, if you increase the price, the market share size will decrease. Whereas for bank elasticity indicates that how willing the customer are willing to shift bank, okay, on the basis of price. So basically jump from one bank to the other bank. If it is elastic, okay, if the bank increase the price, the sales of the bank products, okay, basically the bank sales will decrease. Competition. This factor is crucial as consumers tend to view banks and their service alike. Just like saving account for the 3 local banks, there isn't much difference, okay, between the saving accounts offered by OCBC, UOB, and DBS. If the prices are noticeably higher than those of competitors, sales will be lost. Where banks have similar cost structures, price cutting can destabilize the market and lead to price war. The final result is that the total revenue for all the banks will drop because all the banks are cutting the price down. So sometimes the banks will not in favor of this because end up it's a lose-lose situations. So usually the bank will try to sometimes the banks will maybe negotiate among themselves. Intermediaries, example, brokers, independent financial advisors. This act, basically these intermediaries will add to the overall cost of financial products. As a result, it inflated the price. So bank can overcome it by setting direct distribution channel. So basically, in short, the bank can sell the products directly to you instead going through a third party. This will help to reduce the cost. Regulation. MAS as a central bank provides the supervisory and regulatory framework. This is very important that the central bank provides the right supervision, the right framework in order for our financial industry to function properly. One example is the Banking Act. MAS may determine rates of discount chargeable, rates of commission, and other charges. Pricing policies. We'll be looking at the major pricing strategy for financial services. The major pricing strategies for financial services. They are skimming pricing, penetration pricing, competitive pricing, loss leader pricing, segmentation pricing, value and relationship pricing, tactical pricing, cost plus pricing, and risk-based pricing. Skimming pricing. Basically, they set high price to skim off the cream of the demand. Basically, take the best, okay, the top end customers. This implies quality of service, high quality of service. Penetration pricing. This is opposite of skimming. It's set at a low price. This is with the objective to win the market share as much as possible. It is used when the top of the market is small, customers are price sensitive, cost saving from large volume of sales, and track the competition. Need to win market share quickly. Competitive pricing. Setting a price to match competitive pressure, at least to cover the costs. Allowed for a profit margin. This is used when the market is fiercely competitive. Example, housing loans. Banks will generally generally set the price to match the pricing of the competitors. Loss leader pricing. Operating a service at the lower profit or loss. This is in order to gain opportunity to sell other more profitable services. Example, saving accounts for the kids. So basically, they want you to bring in saving account actually do not generate much profit, even sometimes losses for the bank. But the banks will gain opportunity to cross sell other products that are more profitable. Segmentation pricing. It is similar to skimming pricing. It's designed to appeal to a specific customer groups. Specific customers groups. Each group will pay a different price. Each group pays a different price. Value pricing is the most customer-oriented strategy. It's focused on what the customer is willing to pay. So if the customer is willing to pay for the perceived value of the service, this is what they're basically willing to pay. So basically, it's based on the customer's perceived value derived from the service. The theory is this: more service equals to higher perceived benefit value, higher value, perceived value. So higher price can be charged for the higher perceived value. And this is often used for new services. Relationship pricing. Take note the words relationship. Customers with range of large loans and accounts will be given better rates because in the first place, larger loans give higher return to the banks. As a result, their accounts will be given better rates, to attract the customers to stay with them and to continue to do business with the bank. The focus is not on the service, just purely individual service alone, but based on the whole relationship, the banking relationship with the bank. For example, a customer who has a range of substantial loans and accounts will be given a more favorable rates. Next, we look at tactical pricing. This strategy is to stimulate demands for specific services. The word is specific services, and usually used for short periods only. The possible way is basically temporary reduction or waiver in interest rate or services or fees. Cost plus pricing. Basically, it follows a formula of price equals to profit margin plus cost. It depends on the identification and allocation of all the costs. And this is difficult in real life. It's difficult to accurately identify and allocate all the costs accurately. It's not easy in real life. As a result, it may not result in the price that will generate sales. Next, we look at the risk-based strategy. So it evaluates the risk factor of customers' credit worthiness. This adjusts interest rate based on the risk. So the lower risk, it basically means the bank will charge a lower price. So a less risky customer does not substitute the cost of credit for more risky. So in short, each individually are gauged based on their own risk level, and they pay their own price. Basically the banks will price differently from one person to the other person, right? So markets will in this market new and enhanced credit facilities to customer with good credit standing. And the banks do like customer with good credit standing because they know this customer has high credit worthiness and tend to pay back the debts. Example. So a low risk customer will be charged a lower interest rate. Has a lower interest rate charged. So look at person A and B. Person A is fully secured, low risk. As a result, you charge a lower interest rate at 2 to 3%. A person B is high unsecured and possess high risk, okay, from bank's perspective, deemed to be high risk from bank's perspective. So will be charged a high interest rate, for example, 6 to 10%. So individual person will pay for their own individual pricing. Okay, and the bank will assess individual person differently. Conclusion. Pricing strategy, they balance the demand placed by both the internal and external factors. So basically, there's a lot of things they need to look at, both internal and external. And no, just purely by just look at internal factors. There's so many players or factors that are moving on. There are a lot of moving parts. Okay, in this big ecosystem, even the external factor is even more. Okay, so it's important to analyze and research first for the banks because the wrong price changes could destabilize the market or upset the customers. Strong interrelationship between pricing and the other elements is there's a strong relationship between pricing and all the other three P's. Okay, so prices must be used to support and blend with other elements. So pricing of new products involve the most uncertainty. Okay, and a good marketing manager is to know where and when not to change the price.